Hello friends, welcome back to this second session on adjustment entries. In today's session, we will learn few more adjustment entries. So let's start. The first adjustment entry that we'll learn today is on accrued income. So we know that it is an income, but it is accrued. What do we mean by accrued? Accrued means it is an income which has been earned, which has already become the income of the business, but the amount has not yet been received. So this is an income which has been earned and relates to the current accounting period. But however, it is not yet received. It is to be received. Now for this, let us take an example and understand it. An example could be interest on an investment made. Suppose we'll take that on this particular investment, interest is supposed to be received half yearly, once in the month of June, the other in the month of December. So let us take a financial year. It starts with April and ends in the month of March. So in between this, in the month of June, one time the interest was received, and then in the month of December, again the interest was received. Thereafter, the next installment would be received in the next year in the month of June. So this is the current year, and this is going to be our next year. So what happens is our year ends on 31st March. Therefore, for the period from December end to March, that is from Jan to March, the amount which remained invested, we have earned already the interest amount. But however, we are going to receive this along with the next 3 months, that is from April to June. So totally the 6 months interest will be received in the month of June. So 3 months related to this current year and 3 months related to next year totally would be received in the month of June. So this 3 months from Jan to March already earned income should be included in the income of the current year, although it has not been received. And that is why we pass the adjustment entry here. And the adjustment entry would be, as it is to be included and shown as an income when increases is credited, and therefore we would credit the income account. Whereas this is an amount which is receivable by the business, and therefore as it is receivable, it is an asset, and when an asset increases, we debit it. So we create an accrued income account. So in case of this interest, we would have the entry as accrued interest account debit to interest account. This way, the 3 months interest which has been earned but not yet received, which is going to be received next year, that 3 months interest would be debited to the accrued interest account and credited to the interest account. That way it gets included in the income. Therefore, the general entry that you need to know is whatever is the nature of income which has accrued, which has been earned but not yet received, you would debit that particular accrued income account and you would credit it into that particular income account. So hope that is clear. Now we'll go to the next. This one is also related to income, but here it is income received in advance, means income which is not related to current year but related to next year. It has not yet been earned. You can also get it as unearned income. So you have not yet earned it, but you have received that money. So to understand it, let us take an example. Suppose property has been rented out by the business. So this is a property of the business. So it has a small room which it is not using. So what it did, it has rented it out to somebody else, and it is supposed receiving 5,000 per month for that particular room as rent. Suppose the tenant, as on the month of March, if he pays 15,000 rupees related to March month, April month and May month together, he has paid for 3 months at the rate of 5,000 per month. He has paid in the March month only 15,000. But out of this 15,000, 5,000 relates to the March month, which would be related to the current accounting period. Whereas rest of the 10,000 at the rate of 5,000 per month for the next 2 months, that is for April and May, it is actually related to the next year income which has been received by the business in advance. So in such a circumstance, when the tenant has paid in advance, that would have been received and gone into the rent account. But it is not the income of the current year, so it has to be eliminated. So when we have to reduce the income, we debit it. When it increases, we credit it. When it decreases, we have to debit it. Therefore, we will have to debit it by the amount which is not related to current year. So we would debit the rent account with, you can write rent receipt if there is rent paid. So you can use the account head also, rent received account debit to rent received in advance account. Now, why do we credit the rent received in advance account? This amount has been received in advance, but however, we will show this as a liability in the balance sheet. Why would we show it as a liability? Because in case he comes back, we might have to repay back that amount in case he vacates it. So it is not related to current year, it is received in advance, so it is a sort of a liability for the business. And therefore, the rent account which was credited with the entire amount is debited with the amount not related to current year, and that is 10,000, and it is put into a liability account, that is rent received in advance account. So the journal entry, if you see, whatever is that particular income, that income account debit to income received in advance account. So these are the two journal entries related to income. Either it might be accrued income, that is an income earned not received, or income received in advance. The third adjustment entry that we'll learn for today is related to depreciation. Now, depreciation, what do we mean by depreciation? Depreciation is nothing but the decrease in the value of assets. Now, there are several reasons because of the value of asset might go down. Like there might be normal wear and tear. When you use it, its value is going to go down. It can be because of passage of time, that it has been purchased and a year is passing by, that way the value of the asset. And there are several other reasons which we would learn in detail when we go to the depreciation topic. But however, for the time being, so we know that it is a decrease in the value of asset. When the value of asset decreases, what do? We credit that particular asset account. But this decrease in value of asset is a loss, and that loss has to be debited to the profit and loss account. And therefore, we would debit the depreciation account with the amount of decrease in the value of that particular asset, and we would credit the asset account so that the value of the asset to the extent of the loss in that particular year is credited and the value of the asset is reduced. So this way, the profit or loss determined as per profit and loss account also would give a true and fair view, the correct amount of profit or loss, and at the same time, in the financial position, the value of the asset would also be shown at the correct figure with a reduced figure. Therefore, the entry that we pass would be depreciation account debit to the individual asset account. So these are the entries related to depreciation. So with this, we come to the end of today's session. We will learn few more adjustment entries in our next video. If you found this video useful, please do like, share and subscribe. And yes, don't forget to click on the bell icon to get notifications of the upcoming videos. Thank you. Have a great day.